When money leaves your business bank account or the financial commitment is made, you may wonder, where does the payment show up on your financial statements and then ultimately your tax return? Stay tuned. I'll share the big picture overview of how payments are reported. This is really important to help you see all of the cost of doing business, so that way you can charge the right price and see if your business is as profitable as it should be. So let's dive in. When money leaves the bank account, the payment is classified as one of these three categories. So we're just going to narrow it down to three. The first one is equity, when a payment is made to the investors in the company as a return on investment. When a payment is made to the lender and you're repaying that debt as a loan payment, that's the second category. The third category is a cost, and so it's a cost of doing business. So the way to think about it is, if it doesn't apply to the first two, then we're going to just let it default into the third bucket. It's a cost of doing business. When you're looking at these three types of payments, the first two appear on the balance sheet, and the last one, we need a little bit more information to determine how the payment should be recorded and where it appears on the financial statements. So when you think about a payment, money leaving the business, and we've ruled out the first two categories, so we've concluded that it is a cost of doing business. Those costs are either considered to be an asset or an expense. Now, an asset is considered to have future value for the business. An example would be if you bought a truck and you plan on using that truck for years to come. You don't plan on just buying a truck just to use it for 1 month and then it's useless. It actually has future value. Now, a payment of an expense has no future value. So an example of an expense would be the actual fuel for the truck. In fact, the tank of gas is probably gone before the receipt made its way to the bookkeeper. So assets are reported on the balance sheet. Expenses are reported on the profit and loss statement. When assets no longer have a future value, they actually convert to an expense on the profit and loss statement. So let's look at a few common examples so you can see where they show up on your financial statements. So based on what we reviewed so far on the previous screen, where would you expect to see the purchase of a new truck? Yes, you're correct. Balance sheet. What about the fuel for that truck? Where would you expect to see it? Right again, profit and loss statement. It's an expense because that tank of gas, once it's used up, the value is gone, and usually that's within a few days. So what if you bought a new computer? Where would you expect to find it on your financial statements? Do you expect the computer to provide value for years to come? Yes. So you would record that, not you, your accountant would record that as an asset on your balance sheet. So what about inventory? Would it be on the balance sheet or the profit and loss statement? This one is a little bit tricky because you've got to determine if the company has actually used the inventory during delivering the service. If no, then the parts are still in the truck, so it's considered to be an asset and it's on the balance sheet. And I'll show you how the inventory converts to a cost of goods sold later on in this video. So what about labor? When you pay your employees, where does it show up? On your balance sheet or your profit and loss statement? Yes, it's an expense on your profit and loss statement. And then rent. Where would it show up? If you pay your monthly rent to your landlord, where does it show up? You're correct. It is an expense on your profit and loss statement. And then finally, our final example is marketing. Where do you expect to see it on your financial statements? Yes, you're doing great. An expense on the profit and loss statement. So the next thing that we need to consider is, when do assets convert to expenses? So we've got inventory that we purchased for $10,000. When does it actually convert to an expense and show up on the profit and loss statement? That's when you actually use the inventory and it converts to a cost of goods sold, and usually the materials line. Now, inventory is unique because you may purchase a large bulk of inventory, let's say $10,000, but you may only be pulling it $50, $25, $100. You might be pulling just a little bit at a time, depending on how much you use during that week or during that month to actually provide that service. And so it just pulls based on the actual usage of that part and then the equipment. The next example would be your computer. So when you pay $3,000 for a new computer, it shows up on the profit and loss statement through the depreciation expense process. And so computers are considered to have a 5-year lifespan. Every year, your accountant will record depreciation expense, and it's going to be $600 per year over the 5-year period. And a similar logic applies to trucks. If you buy a new truck for $25,000, the depreciation expense process is pretty similar because trucks also have a 5-year life. So the depreciation deduction on your profit and loss statement would be $5,000 per year. The next thing for us to consider is, are all payments tax deductible? And no, they are not. So when you spend money to provide a return on investment to the owners as equity, it is not. When you repay the principal portion of the loan to the banks, that repayment of debt is not. So we're left with cost. Are the cost of doing business a tax deduction? So we've got to take it a step further and separate it out between assets and expense. The asset is not tax deductible. The expense is, in most cases, tax deductible. Most of the time when you're spending money for the purpose of your business, then it usually is tax deductible. Here's the actual rule where the IRS defines what is tax deductible. So business expenses are the ordinary and necessary cost of carrying on a trade or business for the purpose of generating a profit. So if you can meet all three of those categories, then it most likely is a tax deduction. Here are the most common payments that are not tax deductible. So the first one is owner's pay. Depending on the tax structure of your business, if it's a sole proprietor, LLC, or partnership, then that line item is not tax deductible. Income taxes usually are not tax deductible unless you are a C corporation. Fines and penalties are not tax deductible. Officer life insurance premiums are not. Political contributions are not, and of course, personal expenses are not. Some payments have special reporting requirements, meals and entertainment. They may be 100% deductible or limited to 50%. It just really depends on what the tax laws are for that particular tax year. Gifts over $25 are not tax deductible. Depreciation expense, Section 179, has some special unique aspects of it. Charitable donations, and then also health insurance for the owners. Some of these are tax deductible. They're just represented in a different part of the actual tax form and may have some limitations. When I'm working with business owners, I find that there are 3 costs that are very confusing. And it's because usually the only set of financial reports that the business owner is looking at is based on the tax return. And this creates a really big problem because these 3 transactions are big ticket items. The depreciation on your fixed assets, your income taxes, and the owner's pay. These are all 3 costs of doing business. All 3 must be considered when calculating true profitability and setting the right price. It's vital that you know how these 3 payments affect cash flow, profit, and your prices. Did you know that your business has countless ways to view financial information? Here are the top 7 that I find most helpful for business owners. Now, I want you to notice how the tax piece is a small piece of the overall financial picture. One way to help you kind of keep it straight is to think about the first 3 as foundational to your financial world in your business. You've got strategy, price, and cash. And everything else builds off these three financial viewpoints. The last four are actually simple reporting formats of how cash flows through the business. The costs that qualify as an expense show up on the profit and loss statement to calculate net income. The cost that's considered a tax deduction shows up on the tax return to calculate taxable income. The costs that are considered assets show up on the balance sheet to calculate the net worth of the company. Before we dive into the three most confusing payments, let's take a step back and really consider the different financial viewpoints that we are looking at: the profit and loss statement and the tax return. So first we need to consider who was the report designed for and why is it important. The profit and loss statement is designed for you to see true profitability. The goal is to match income and expenses in the right time period so profit is stabilized and tells the true story that is happening in your business. The tax return is designed to help you stay compliant with the IRS, and it calculates taxable income. I want you to notice how very different these reports are. They provide different purposes and they calculate very different numbers. In the accounting world, there are a lot of different methods for preparing financial reports. And for the profit and loss statement, it's usually referred to as book basis. For the tax return, tax basis. I recommend for profit and loss statements to request an accrual basis profit and loss statement so that way it's a more accurate report. For the tax return, you may be able to choose between accrual or cash. Just kind of depends on the rules. As a service company, I do recommend cash if you are able to. So back to our three most confusing payments: depreciation based on our assets, income taxes, and then owner's pay. So when you purchase a truck, the full amount of the asset appears on the balance sheet. The asset converts to an expense through the depreciation process. So for your internal set of books, the profit and loss statement is going to reflect depreciation expense, and it's going to be reported at a rate of $5,000 per year. The depreciation expense reduces your bottom line and reduces your net profit. For tax purposes, you may qualify for Section 179, and where you're able to claim the full amount, that full $25,000 in the first year. So the depreciation tax deduction reduces taxable income by $25,000 in the first year, and there is zero tax deduction for this asset during the remaining years. The second payment that's often confusing is income taxes. Income taxes are a cost of doing business. They should be reported on your internal financial reports so that way you can see the true cost of running the business. For tax purposes, the payment is most likely not a tax deduction because only C corporations are allowed to claim income taxes as a deduction. All the other forms of tax entities are not. The third payment that can be very confusing is owner's pay. I want you to keep in mind that you are not volunteering for a charity. You are investing valuable time into your business. It's important to see how much your time contributes to the business and then consider how it impacts true profitability. Now, whether or not the payment is tax deductible or not is a different story, but it's very important to see the information on your profit and loss statement so that way you can see true profitability, plan for taxes, and then also make sure that you are setting the right price. Here's a little recap. When money leaves the business bank account, there are three ways to categorize the payment. It's either equity, debt, or a cost of doing business. The costs are then narrowed down to either an asset or an expense. Assets eventually are converted to expenses over time, and then most business expenses are tax deductible. The bottom line is identifying whether the payment is an asset, expense, or tax deduction is an important piece of the financial puzzle. The information helps you connect how money flows out of your business and affects net worth, profit, and taxable income. This is very valuable information to consider when calculating your prices and planning for the future. Thank you so much for watching. As always, if you've got a financial question, please reach out. I'm more than happy to point you in the right direction.